Assalamualaikum warahmatullahi wabarakatuh. My name is Rizky Bini Darmawan. I will present about resume video meeting part 2, strategic financial management. So first, capital structure. The combination of a company long-term debt, preferred stock and common stock is referred to as its capital structure. The price of the various forms of capital that a business must utilize to finance its operation is known as the cost of capital. It is the rate of return a business must give investor in exchange for using their money. It is the bare minimum return on investment that a business must achieve in order to please its stockholder. Understanding the cost of capital is crucial for business in order to deploy resources efficiently and calculate the return on their investment. Companies must compare the possible return on their investment with the cost of borrowing money, issuing equity, or issuing debt. So, the way a firm distributes a portion of its income to its shareholder is determined by its dividend. So, the weighted average cost of capital for the firm determines the cost of capital, WACC. This represents the average cost of the various capital sources that the business employs to fund its operation. The company present capital structure as well as its anticipated future capital structure are both taken into consideration by WACC. It is computed by averaging the cost of each form of capital by how much of the total capital the firm has been allocated to it. The cost of debt, the cost of preferred stock, and the cost of equity are the WACC component. The interest rate that the business must pay to its lenders constitute the cost of debt. And the dividend rate that the business pays to its preferred shareholder determine the price of preferred shares. The return that the business must give to its common shareholder is known as the cost of equity. When assessing a company performance and choosing its capital structure and investment, the cost of capital is a crucial consideration. Even investment is a wise use of the firm resource. The cost of capital of the company should be compared to the predicted return on the investment. When choosing their capital structure and what to invest in, business must take their cost of capital into account. A company profitability may decline and its competitiveness may suffer due to a greater cost of capital. And next, dividend decision. The way a firm distributes a portion of its income to its shareholder is determined by its dividend policy. The dividend rate and payment schedule are normally specified in the policy. The size of the dividend, the payment method, the declaration date, and the record date are just a few more components that might be included in a company dividend policy. A company dividend policy plays a significant role in its entire financial strategy and has the potential to affect investor choice. Companies may make use of their dividend payout plans to reward shareholders, draw in investors, and inspire belief in their stock. Next, IPO process. IPO is the method of a company advertising its stock to the public for the primary time. It could be a way for a company to raise cash to support growth, increase working capital, or obtain other companies. The IPO prepare can be complex and includes numerous steps, counting the recording of a enrollment explanation with the SEC. The first step of the IPO handle is to choose an hypothesis bank or agent. The company will organize with the speculation bank over the publishing visit of the stock and other terms of the publishing. This transaction will customarily incorporate a route show up in the midst of which the company and its administration gather will meet with potential theorists to conversation around the proposed publishing. So, once the term of the promoting are conjured upon, the company will record the enlistment articulation with the SEC. This record gives information regarding the company's commerce, its cash-related position, and the term of the promoting. The another step is to set a date for the IPO. This date is more regularly than not chosen by the vendor bank and may be affected by grandstand condition. A few times, as of at the IPO date, the company will set a settle number of offer to be published and a settle taken a 2%. This broke is chosen by the minder bank and is around the upper based on their assessment of the show off. On the IPO date, the offers are published to the open. Cash-related experts can buy the offers through their broker. On the off chance that the advancing is profitable, the company will get the stores from the advancing and the stock will start exchanging on the stock trade. And then the IPO handle can be complex and time consuming, but it is an essential step for different companies that are looking to raise capital and increment their profitability in interior the money relate. Next, behavioral finance market anomaly. So, a relative young area of finance called behavioral finance aims to comprehend and explain market abnormalities brought on by irrational investor behavior. According to behavioral finance theory, investors may not always make rational judgment and may be swayed by cognitive bias or emotional reason. Events or trends in the stock market known as market anomalies appear to challenge established financial theory concepts like the efficient market hypothesis, price momentum, the small business effect, the value impact, and the size effect are the four most prevalent forms of market anomalies. These anomalies are explained by behavioral finance theory, along with how they might be exploited to spot successful investment opportunities. Okay, so it is my presentation. Pardon me if any mistake in my presentation. Assalamualaikum warahmatullahi wabarakatuh.